Is this a go?
This is a go, our new look podcast. We're continuing to work on making this easier to do so we can keep bringing good content to everybody.
What's been the delay?
Well, the delay has been the editor was away a little bit, but no, we have got a good plan in place for the future, I think.
Not you're trying to muzzle me so I don't get to say what I want for the last...
There was a little bit of that too, but it's been pretty smooth sailing so far, which
All
we're
right.
going to get into today. So, and the Olympics, so a quick shout out to all the Canadian Olympians out there.
The Summer Macintosh, I call her a kid, has been phenomenal, standing up, cheering for her. So
She's only 17 as
17
well,
years old.
so Charlotte and Briar have a little bit of work to do in the pool, I think.
it's unbelievable. So it is kind of neat seeing that. So
I'm excited to watch the Canadian golfers. Hopefully they put on a bit of a show too.
yeah, that's going to be a tougher one to get, but you never know. The tennis player I just found out today, he went Medvedev, whatever name, rank, person, so he's in the quarterfinals unexpectedly, so you never know.
We usually start off with a quote. Usually you do the quote, but I got the quote this time.
Go ahead.
I got the quote this time, so I'm going to read this here. Adulthood is saying, but after this week, things will slow down a bit, over and over until you die. I thought that was good.
Is that kind of relax? You can relax when you're dead?
Life just continues to happen no matter what your best plans are.
Exactly.
Mm-hmm.
That is true for sure.
Great. So moving into our first segment here, we have a new segment, a new way to do this first segment here, the Fast Five. So I'm going to zip through 5 quick topics here. One of them you're not aware of that I'm going to bring up. So a little bit of a surprise, throw you a curveball here. Had to include this one though. So
Nothing you do surprises me anymore, but keep going. Go ahead.
so let me read it to you and then you can give me the quick lowdown. We're going to get through 5 in 5 minutes here.
Okay.
So Canadian employment rate is down. The employment rate is the proportion of the population that's actively working or contributing to the economy. So it's down to around 60% now, which is the lowest level it's been since, even lower than 08-09, the great financial crisis, and down to 2001 dot-com bust levels. So what that means is 60% of Canadians of the labor participation force is actively working and contributing. 40% are not. So when this rate goes down, the employment rate, it's not good for the Canadian economy.
So those 40% of the people are actually looking for work but can't find work? Is that?
No, they're just not out of the workforce, not working, so a combination of that.
Yeah. Or they've looked and can't find, now they're out of the whole...
And I thought it was an interesting quick hit one just because of how dramatic it is down to 2001 dot-com bust level. So
Okay.
that was the first one. Small cap outperformance. You love the saying reversion to the mean, or the theory of reversion to the mean. So you like to quote that one.
It's not a theory, it's fact.
Fact. Sure.
Eventually they we get to that point again.
Yes, yeah.
Okay.
And broken clocks are right twice a day. But the Magnificent Seven stocks, the Teslas, Apple, Amazon, Google, Nvidia, Facebook,
You said Microsoft?
Microsoft, that's the last one. They've been outperforming small cap counterparts, which small cap stocks they're a market capitalization. So the size of the company is around 300 million to 2 billion is usually the range for small caps. And out of the last couple of weeks here, small caps have really rebounded, reverted to the mean, up over 10% in the last couple of weeks, while the S&P 500 down 3% when I pulled this stat earlier this week. So that 13% spread is the largest it's been ever over any 12-day for small caps.
Yeah, I'm not even so sure you can say the 7 against the small cap. You can say the 7 against everybody else in the S&P as well. It's not just the small cap that they've outperformed, right? So,
Definitely, yes. And I think the reason that the small caps were interesting is historically when rates come down, that's usually a good thing for small caps. So,
Right.
As always, diversification is the key, but looking at small caps here might be beneficial as rates continue to come
well,
down.
they've been out of favor. It's time to look at them. I agree with that.
This one,
See, I agreed with you.
oh, there you go. Hey, once in a blue moon
There you
here. We still got some time left. So this one, you do know this stat.
Yeah, but why are you smiling?
You do know this
Because
stat.
you're setting me up
Well,
again. Go ahead.
it's a bit of a setup, sure.
No, go ahead.
this one might be a topic on its own on a future episode.
It sounds like it will be, but go ahead.
Just quickly here, the average Canadian family last year spent more of its income, I'm going to read this, on all forms of taxation, 43%, than on basic necessities such as food, shelter, and clothing combined, 35%.
What's your point?
According to a new report by the Fraser Institute. So taxes continue to be one of the main expenses, the largest expenses for Canadians. And I think
So you're not talking about, you're talking about all taxes. You're talking about all levels of taxation.
it's sure, yeah,
Right?
it is all forms of taxation. Yes.
So my municipal taxes on what I pay is
and
part of it.
I believe that was
CP
in the Fraser Institute report. Yeah.
Okay.
I think that what I wanted to point out here is that it's the average Canadian family and not just the top 10%, the
Right.
top 1%. The average Canadian family is spending more on taxes than shelter, food, clothing combined, which is a bit
So what you're saying
staggering
is
to me.
they're unhappy, is what you're saying.
Well, I'm not saying, taxes certainly help
you
and you
happy?
need to pay taxes to run the country, but the average
Correct.
Canadian family spending more on taxes than those, probably a little bit too much, my opinion.
Okay.
As per that previous chart, if that wasn't enough, something that you have mentioned before for years as a potential, capital gains on principal residence. I only bring this up. I hate to.
Are you setting me up here? Like, what are you trying to do?
I only bring this up because I'm hearing more whispers about that. I think it still is unlikely. It'd be tough to get votes running on that. But I did notice the chart that was showing the government is actually tracking. The government of Canada is tracking somewhere in one of their reports the how much your principal residence tax exemption costs them. So every time a house is sold under the principal residence exemption, it's being calculated what that would have been tax-wise if they did have capital gains on that. So interesting to see that.
Am I allowed to rebuttal this?
You
point?
are, yes.
You,
yeah.
you do understand that the people my age who purchased the house for $150,000 or $200,000 is now worth $1 million
Sure.
are sitting on a huge equity enhancement,
Yeah.
etc. And then the younger people, or the ones that are 25, 30, 40 years old, that bought the house at 650 or 7 and it's worth 800,
Yeah.
their liability is far less. So the government is looking at people who have had it for a long period of time. And
Well, I mean, I'm sure that person that has the house probably doesn't plan on selling their principal
No.
residence at any near point in the future.
but he will. At one point
Of
in
course,
time,
and then
something will happen.
they'll pay the bigger bill as well.
If this gets implemented.
Of course,
Right,
that's
yes.
which is still
Is
a
that-
large if.
Isn't that no different than an RSP? You can accumulate all this money, don't pay nothing, you die, then you pay. So right now, the estate has the principal residence out free.
Well, you didn't pay tax in the RSP. You got the tax back on that. So this is different. That you bought the house with after tax dollars. You paid for it with after tax dollars. That's the smile when you say gotcha.
Okay, you didn't get
The next
nothing.
one,
But anyway,
last
keep
one
going.
in the fast five here.
Go.
Nvidia stock. Of course, we don't recommend any buy or sells. I thought this was an ironic point here. If
Be
you
careful what you say. Go ahead.
Look, recent total return data ranks Nvidia as the highest performing stock over the past 20 years. So in just performance based, it has the highest rate of return out of any stock in the last 20 years, over the last 20-year time period.
And it dropped.
However, since this picture was taken of the CEO signing a woman's shirt like he's Bret Michaels of Poison,
Okay.
they're down over 10%.
Right.
So it was ironically,
And today,
it seems like that's the top there.
and today,
Yeah.
as we speak, not that I'm a guy that looks at news like that every day.
Yeah.
The stock is up 13% today.
Okay, so there
So
you
I
go.
just let you know.
There you go.
The lady with the signature comes out ahead.
She's
But anyway,
coming back. Okay, all
go
right.
ahead.
So maybe he is a rock star. So,
Okay.
So there you go. So that was our fast five there. So moving on to the first home savings account, our next topic. I think this was an important one for both of us to include here because we really feel that for anybody that is saving to buy their first home, opening up a first home savings account is a no-brainer idea, no-brainer solution here.
I think you can add the word, it's a must, not even a thought. It makes absolutely no sense not to do it. So
In so many conversations with clients, we talk about the pros and cons of opening up a
there's
certain
no con.
account or
There's
the
no con
investment,
here.
and there's really there's the it's difficult to find that negative with this account, especially if you're if you're fairly certain that you want to purchase a house in over the next 15 at some point in the next 15 years, your first place. They're tax deductible, tax free on withdrawals, just the perfect way to help get closer to that home ownership dream.
And I've always been a fan of RSPs. It just the way, because of when I was born, this is an RSP enhanced, even better, because of the fact that you can get this money out without having to repay it back. So this is clearly something that everyone should be looking at. Clearly, especially if you're working.
Yeah.
If you're working and you come here and we tell you to buy an RSP, and you've never purchased a house, we will definitely steer you. And that's, the government does set the $8,000 a year, and there's some rules.
Yeah, and let's talk about that a bit.
Okay.
So what are they? So if you're between the age of 18 and 71 and a first-time home buyer, you're eligible to open up that account. The contribution limit is $8,000 a year from the moment you open it. So that's one of the kickers, is that your contribution room, unlike a tax-free savings account, sometimes we get a client come in that has never had a tax-free savings account before, and then they can put the maximum because they've been accumulating contribution room since the day they turned 18 in 2009. So
This one you have to open it.
You have to get it open. So that's why it's even more of a push to seriously consider opening that sooner rather than later, so you can start accumulating that contribution room. Even if you can't get that $8,000 in the first year, let's get it open just in case next year situation changes, job changes, things like that. You might be able to get some backdated contributions in there the next year.
And you only go back 8,000 at a time, right? You do current year and 1 year back. So the fact that you opened it is a big advantage. Even if you put $100 in there, you should open it.
And the big advantage, the major advantage, is the tax treatment. Contributions are taxed similar to an RSP contribution, where you get that tax deduction. So if you're, depending on your tax bracket, of course, but that an $8,000 contribution to the first home savings account could generate for you that tax refund depending on your tax situation. It's going to save you some tax, put some more money in your pocket.
100%.
Which that just gets you closer to saving up for that down payment, right?
Yeah.
So that's how it's similar to an RSP. How it's similar to that tax-free savings account is on the withdrawal. So let's say now you've been saving in that account, you buy the house, you say, hey, CJ, hey, Jerry, bought the place, I need to get that money out now. Okay, you have a signed deal, great, qualifying home. Now you're taking that money out. Any interest, dividends, capital gains you earned within the first home savings account come out tax-free as well. So there's no fees or tax implications in terms of when on that withdrawal amount or penalties to get it out, as long as you're buying a qualifying home there. So it helps keep more money in your pocket when you're looking to get your down payment together.
Let's remember, so people understand that if you earn $100,000 or some number and you put the $8,000 on your tax return, you're telling the government you made $92,000. So that 100 that you earned at 30%, we'll just use 30 as my guideline here, 30% times the 8,000 that you just put in, you just literally saved $2,400 of tax. And then you buy the house, you don't have to pay that back. This is as good as it gets.
Which is the differentiator between some people may have heard of the first-time home buyers plan, where you contribute to your retirement savings, and then you can pull that money out for the down payment, which is still a great plan.
Still good.
Still a good plan. The first home savings account, I think, trumps that plan because
no repayment.
No repayment. So again,
we can talk with that. People that want to do that, we can always give them more details when we see them. But clearly, put it on your radar. If you're a person who does not own a house and is thinking about getting a house, not this year or next year, 5 years, 10 years from now, let's get some money in there. It's a huge advantage.
And there's no there's no minimum requirement for the funds to be in the account, unlike the first-time home
No.
buyers plan. So if you're buying a house in 2 months, you can still put that money in there based on your contribution room to top that up. Really take advantage of that to get that refund next year, hopefully. So
Yep.
they're easy to open, and we'd be more than happy to chat more with clients about that.
All right. See, there's something we agree on.
You know, you're getting a little softer in your old
No,
age
no,
there,
it's
boss.
all right. Keep going. Keep going.
So the next topic, kind of leaning into first home savings accounts and continuing on the housing front for first home buyers, condos. So
How are they doing?
becoming more and more of one of the biggest challenges that Canada's facing in the economy right now. One of the charts we have here is the share of newly completed GTA condos with a mortgage that are cash flow negative. So you can see in 2020 that was 40%, and in first half of 2024 that number's gone up to over 80%. So to put that in perspective, what that means is 4 out of 5 people that you know that have a newly completed GTA rental condo unit with a mortgage, so people that you know with rental units in rental condos, it's costing them money monthly, more money than they're bringing in.
And I think that number was somewhere around $600 to $800 negative cash flow.
Yes, yeah.
That's an average number.
you're
Some are more or
exactly right,
less,
on
but I think I
average, yeah.
recall reading that it was
And
six
one of
to
the,
eight
just,
hundred.
just to kind of nail that point home, one of the other numbers was over 30% are cash flow negative by $1,000. So that means that, Steve owns a condo in Toronto and he has his rental income coming in and he has his expenses. He is net negative. It costs him over $1,000 a month just for that condo. And that might have been okay when condo prices, the value of condos, were going up.
And the interest rate,
monthly.
the carrying charge of the interest.
And that, which, that's included in some of the costs there, but that might have been okay when the value was going up. But looking at some of the numbers more recently, since June 2024, some numbers have condos down 13% over the last 2 months here. So now you have that double-edged sword of condo prices coming down and costs going up. So I wonder how that affects the market.
And we won't even talk about the dilemma we having actually with the whole rental business of stuff, meaning tenants and landlords. That's a conversation by itself. But the bottom line is, my understanding is well over 50% of these are owned by people who already own a house. So this was an investment for them that basically was peddled by developers. Don't worry about it. You buy this for $550. It takes 4 years to build.
A lot of pre-sales.
Well, you need to have 75 to 80% pre-sold
Or pre-built,
before the crane goes in the ground and starts building, right? So now I tell you, get this at $550. In 3 years from now, this thing's gonna be worth $750.
We're selling phase 3 at $750.
And I have no outlay right now because it's not being built. But as we get closer to completion,
Yeah.
that's when the bank comes knocking and you have to do your financing. And then all of a sudden you realize, oh my God, my own mortgage is coming up and it's more. This one's the assignment of passing it on to someone else. There's not as many people rushing out to purchase it as there was before. And the other thing that I read was interesting. The vast majority of these things that were built were studio and 1 bedroom because they were easy to rent, cheaper and flip. But how many take you? Are you rushing for a 1 bedroom condo with a wife and 2 kids? I don't think so.
Probably first-time buyers is
Exactly.
yeah.
So the family people,
And there, I think there
They're
is
not-
a lot of people that are single or looking
Yeah.
for a place like that, and that's why it feels like everything's intertwined.
There's
we have a
less
shortage
demand.
of supply
Yeah.
because a lot of these units are empty because the buyers haven't been able to qualify to take them over, or they didn't want to commit to taking it over because the price came down, or maybe they can't afford it. And then you have rental prices that are going through the roof in the GTA, Toronto. All the numbers seem to be that seems to be one of the biggest factors in inflation is the rental prices. So it seems kind of like an easy win, which obviously there's more layers to it than that. It kind of seems like an easy win to somehow, if we could get these into the rental supply, that might ease that demand a little bit, because there are tens of thousands of these
The
units
only
that are
way,
out there.
the way you get in the rental supply is the owner has to close the deal, take ownership of this, and then put it on the market to rent. And then the cost of rent, like you said earlier, if he's comes out negative, he's gonna want to sell it. So then it becomes owner occupied, back and forth. Who's buying it to move in? Who's buying it to invest? Until those prices come down, and somebody gets hurt, right? The people that put the down payment or the equity into this thing are going to get hurt. So we're bringing it up, I think, because I think you're going to hear more of this over the next 6 months, 12 months.
Certainly.
And it's hard to grasp what's going on, but I think Toronto was the number one place for condo development. Forget about Ontario. I think it was like ranked in the world as the most condos being built in an area, metropolitan area. So it's a problem, and I don't think it's going away anytime soon.
And I think it speaks to kind of the value that we aim to provide is a sounding board and having a conversation with clients about the pros and cons of something. And just because it's happened in the past doesn't necessarily mean that's what's going to happen in the future. And I think being aware of it, not
the risk side of the
but
equation.
being aware of it not means that you're not going to do it.
No.
Being aware of the downside.
What could happen
Helps helps set your expectations properly, and helps avoid the chaos. Yeah. All right, our next topic here, burn rates. So I think we've talked about this before, but we've had a lot of meetings with clients recently, chatting about clients so who am I talking about? Clients approaching retirement, clients in retirement, that are wondering, okay, what's a sustainable amount of income that I can live off of? Let's look at a retirement projection and see how this looks. What do I need to do here to be prepared for retirement? What do I need to do to live comfortably and be able to do what I would like to do in retirement? So the one thing that keeps coming up every time is the burn rate. So what's a burn rate, Jerry? Tell the people.
Well, the burn rate is when you do your calculation on your charts, and I see that yellow number. I think it's a yellow number that comes up.
It's usually highlighted, yeah.
And basically, you deposit a lump sum of money. How much of that money is being burned on a yearly basis versus what we can earn on this amount of money. So I've seen you do it numerous times, and lots of clients have seen it. When the number is 4 and 5%, I can sleep at night. I'm okay with that thing. When I start seeing 6, 7s, and then an 8s, basically, it's, in my opinion, it's almost unsustainable in that we have to direct these people into all equities, into more moderate to high risk investments. And we all know at any given time, the risk goes up, right?
Yeah.
So I think that the burn rate leads to how much money do you need to live on, and that is a single most important variable that will lead us to that number. But I think people have to live within their means and have to figure out, I really need $6,000 a month, but that puts me at 7% burn rate. But if I can live at $5,000 a month, it puts me at 5.5. They're not happy at 5, but realistically, that's going to make their money last.
And that's what the balancing act that when we're chatting with clients, it's some clients say, I would like my money, I'd like to have an estate, and I'd like to pass on funds or look at charitable options, charitable strategies, things like that. And some say, I want to spend it all, and I'm not living past 85.
Right now, I'm at good health where I am in life right now. In the next 10 years, I want to be able to enjoy my life, so I want to spend more. I'm not really concerned what happens when I turn 75.
And there's those unique circumstances, but I think when should you start doing it? You should start planning as soon as possible. It never hurts just to look at it and to try to because there's certain strategies that can be implemented in the meantime right away that can help avoid additional taxation in the future when you're withdrawing those funds, which again, that affects your burn rate. If you're paying more tax, that affects the burn rate.
And I do think that insurance companies, financial banks, historically have always used 4%. So if you burn 4% of your money, you will never run out of money.
Sure. Yeah.
Well, 4% is great. It'd be great if I had $5 million. You know what I mean?
Yes.
If I have this amount of money, you know, that equals 15,000 a month. Well, not everybody has that. So the 4% number, if you saved $500,000 and I go 4 times 5 is 20,000 a year, and I say, oh, you can take out $1,500 a year. As we know right now, the way the world is, it's not enough. So we either have to start saving a little bit more money or delay when we start the burning of our funds, right?
Yes.
And that's where you come and talk to us, and we kind of give you,
Build that plan.
we see what's going on, right?
Yeah.
There's no right or wrong here. It's just a matter of being realistic and try not to sugarcoat things to make, oh, you're going to be okay. Oh, you turn 73 and have no money. I'm not into that discussion. I would rather tell you I don't like it.
Yeah.
So you know the way we talk to people, et cetera, with clients.
There's so many assumptions that come into play, like the rates of return and inflation and your life expectancy, but only the client can tell us how much money they spend. As you
Right.
say, we're not following them around to see
No.
where they're spending their money. So at the end of the day, I can tell you what your sustainable burn rate is, a sustainable amount of annual income to pull out of your portfolio, where we feel comfortable. But you know where you spend that money. So working on that number and having a good idea of what that number is going to make retirement even more comfortable for you. And give
I
you some
always
more
smile
peace of
when
mind.
somebody says, well, how much money do I need to retire? Well, how are you asking me that question?
If you can live off of $30,000 forever, then you know this amount of money is good, and you can retire tomorrow.
Right.
But
If one
not
person
everybody can do
says,
that.
you know, $3,000 a month, I can live happily ever after, and the next person says, $3,000 a month, I'll be on the streets.
Yes.
So you can see everyone's in a different position.
Exactly.
But the number one thing, you said it perfectly, get in here, have a chat, see it in front of you, so have a plan. Do something
and
that
be
tells
cautious
you.
of what your neighbor says they're taking out, because again, everybody's unique and everybody's different, and that's why we try to work individually with clients to create those custom plans based on their lifestyle and needs.
Don't try to
and
get
goals.
Don't try to get out of this by saying burn rates of 7 and 8 are okay. They're not.
I don't care
how
agree
much
with you
money
there.
yeah, okay.
I agree
That's
with you
good.
there. That's when it starts getting a bit too
Right.
high. Yeah.
Exactly.
And so our last topic here is election year performance. I've been waiting to do this one. This is one of my favorite. It was, as you like to point out, I've been in the industry for almost 15 years now. I don't quite have the gray hair, although you don't have much gray hair yourself. But I do like to lean on, although past performance does not predict future performance, I do like to lean on historical evidence to give me an idea of what potentially we're looking at here. So I wanted to chat a little bit about election year performance, how the S&P 500, how the markets do, and how our clients may be affected by that through the year here.
And that's fine. I know you like this kind of conversation, and checking the history back is fine. And you know where they always say the old is not new and the new is not old, and they go back and forth. Elections happen every 4 years, and we know in the U.S. you can't do it more than 2 terms. We know all that. But I would have to say, as we go forward, who's running, parties running, how they feel, even though historically we have a 100-year record of this, I do feel, I don't want to say it's different now, because the minute you say it's different now, it always comes back, reversion of the mean, right?
Yes,
it does.
yeah.
But you have to sense there is a different feel, more tension, more stress.
I think
than usual.
noise
That's all.
and news and
That's all.
the
And media.
the
Media.
access to information and the
Yes.
way that media is.
Maybe that's
where,
what it is.
You know, there's a lot of clickbait out there. There's a lot of, these guys are, you have to remember that every news article you read, every headline, that you read, somebody is behind that and funding
Absolutely.
that, so it's...
And steering it.
And steering it.
Absolutely.
So yeah.
And we didn't have that 20 years ago to the degree we have it now. So you're right. I guess maybe that's what I think the biggest difference is.
But I think we still can look at what's happened in the past, because that's what people have said every year throughout history is this time it's a little bit different. It's more intense. It's more this, it's more that. And I think so far this year, historically low volatility. And if for our clients that, view their investments regularly, we try to get them not to check it every day. But for those that you view it regularly, I think they would agree as well from our conversations that we've had a pretty
They're happy.
we've had a pretty easy run here, other than a little bit of a blip in April. It's been relatively up. So historically low volatility in the market. You can look at the volatility index. It's around 13, 14. The average is closer to 20 on so about 50% more ups and down swings throughout the year. We've had a bit more. We had a 2% drop recently over the past couple of weeks. And
When's the last time there was a 2% drop?
it was over, I'm happy you asked, because I do know that. It was over about
figured you
350
did.
trading days.
How many?
350 trading days ago, which is one of the longer streaks the market's gone on. So, and it doesn't, a lot of times forward-looking returns still look good, even when you have 350 trading days without that 2% drop. We got that drop. I think what I wanted to get into here is, all right, so first half of the year, we've had low volatility. So in a normal year, you'd expect more volatility. Forget that it's an election year, but it is a U.S. election year. And when you look at the historical data, the historical performance, we have a chart here that's showing the blue bars are showing the average return of the S&P 500 in that month. So if you look at June, for instance, it's 1.3%, and the diamond above there is 83.3% higher. So 83% of the time, going back to 1950 in an election year, the S&P 500 was higher. All fine and dandy. What do I want to highlight here? September, October is where we usually see the downside. And I think that makes sense because we have some pre-market jitters as we approach the November election cycle. What does the market dislike the most? That's a quiz question. Wow. That's a quiz question. It's a one-word
Uncertainty
answer.
They don't like is what they don't like. Is that what you're asking?
Ding,
Leading me.
Give them a bell. Yeah, exactly. So I think they don't like that uncertainty. I don't think,
You recall what happened the last election at this time, right? 4 years ago. You
do recall in 2016 when Trump started winning on election night, and the Dow Jones dropped almost 2,000 points, I believe.
It was a big number. You're right. It was a big number.
And that was a lot bigger percentage of
the
the
Dow wasn't
Jones
40
at that point. So that was scary, but I believe, and I'll have to double check, get our fact checkers to check this, but I do believe that day, the next open day, it ended up positive coming out of that. So after hours, it was down. So again, either way.
I think there was actually a swing during the day, the actual day too.
Yeah.
Like
so the volatility increases, and I don't think the market particularly. You can see that in November, it's actually quite positive. One of the best months in election years is November. So once we get some certainty and everything cools down, we historically, we see that bounce back. And that doesn't matter if it's a Democrat or a Republican.
Right. We need calmness.
And you just need some of the certainty of what's going on.
That's right.
So I think the message here is the message
here is we're going to have volatility for sure. Mm-hmm. We've had a free ride.
Yes.
Basically right now. As we get closer to the election, there's going to be words being said, media, mm-hmm. Instagram, Facebook, whatever you guys use here. There's going to be more of that.
TikTok, don't you?
No, I use TikTok. Okay, I get my information from TikTok.
Okay, even better.
Don't make fun of me, okay? But there's going to be more information out there. It's going to affect what people think and say, mm-hmm. and it's just going to get ratcheted up.
I think historically, I think the message here is that the uncertainty is going to be there. Biden stepping down creates more uncertainty. And if we're reviewing history, we got to, for clients and for us, brace for a bit of a bumpier road ahead over September, October, but sit tight because things have a way of bouncing back when that certainty comes back into play after the election. And the noise, try to avoid that noise because it is a lot of noise.
All this stuff, we're professional financial planners. Our job is to look after people.
We're certified financial planners,
What did I call us?
professional financial planners.
Okay.
We're certified financial planner professionals.
Certified
I think
professionals.
is the
Okay,
right way
whichever
to.
term you
I
want to
don't
call
want
it.
the Financial Planning Standards Council coming after you. So
Okay.
we are certified financial
Our
planning
job is to
professionals.
look after people. And the conclusion really is, at the end of this, you hear it all the time. You diversify your portfolio. You have a better understanding of the risk going forward. There's going to be, how many times in the last little while we're telling people they're really happy, markets are up. Don't get too excited. There's going to be a little bumpy ride along the way too.
Yeah.
So I think this is a very good example that things have gone fairly well for most people who've invested. But if we go back to 2022, they weren't so good. And, again, credit to our clients, credit maybe us holding their hands or calming them down. They were able to ride this out, and it's a much better ride right now than it was before. But there's going to be uncertainty. There's going to be volatility, whatever term you guys use.
And
So-
volatility at the end of the day means downturns. And we just haven't experienced that normal downturn that you would see, that normal correction that you would see in any given year. So I think those risks are coming into play and may come to a head through September. But of course, as you say, our crystal balls are a bit foggy. So stick to the long term.
There was a thing that you showed it to me once, that over the course of a year, take the S&P,
Yeah.
you could have a low point
Look at that. This is my favorite chart.
of whatever it was. I recall it. I'm giving you credit here.
Yeah.
It was like you're down 10 and you finished the year plus 9. So you see a plus. That was a pretty good year. Meanwhile, during the year, there was chaos.
Yes.
So I don't want to tell people just look at your statement.
Take a vacation and look in December.
Right. I will say where we are today, that I think it's better than expected.
The market has been resilient this year
That's
for
all.
sure.
So I don't know how it's going to end, and I'm not going to say to you I will be happy if it ends where it is today, because we're still going well. But try not to get caught up with all the noise.
Stick
It's
to
gonna
the
happen
plan.
again.
Focus on the plan. Don't focus on
Right.
the short-term election and market
No,
noise.
no, it's gonna
and news.
Who wins, who loses, what happens. Your taxation number gets everyone riled up, etc.
I knew that one would get you.
It gets everyone riled up. At the end of the day, you have to look at your own particular situation, where you are,
Yeah.
how much money you've saved, what's going forward, and we can help you, direct you what we perceive to be the right way.
Yeah.
Like, I just don't like taking unnecessary risks. And sometimes you take risk and it works out great. But as we're trained, as you get older, you tend to take a little bit less risk because you don't have the time to recover.
To bounce back.
That's all.
Yeah.
So
Yeah. So that's it for us today. We look forward to your feedback and hope you enjoyed.
sounds good. And let's do this a little more often and get into topics where
Simplify.
where I can rebuttal back. Okay, you set me
Gotcha.
up a couple times here, but we'll leave it at that. And go Canada, go! And let's get a few more medals and make us proud.